And when we talk about contract costs, every cost must meet certain requirements before it can be charged to the government. The Federal Acquisition Regulation, FAR 31st, provides the framework for a government contractor to determine whether the costs can be charged to the government. And there are four main concepts: allowable, allocable, reasonable, and supported by documentation. So for allowable, some costs just can't be billed to the government by rule. The examples could include entertainment expense, alcohol or lobbying, and advertising. So we need to make sure the costs we build are allowed and then allocable. So a cost must benefit the contract being charged. For direct cost, it's more straightforward. If this cost is used directly to support a contract, those are direct costs and are charged to that cost. But for indirect costs, it could be more complicated, where DCA actually requires the business or government contractor to have a logical and consistent methodology to allocate indirect costs to different direct contracts based that they are actually benefiting. And for reasonable, just to think about what a prudent business owner will incur such expenses under a similar situation or circumstance. So any inflated or excessive costs are not allowed. For example, if the business needs to purchase a vehicle, a regular vehicle like a Honda might be okay and reasonable, but definitely not if you're going to purchase a Lamborghini. So, and the fourth is supported by documentation. Every cost will need to be supported by documentation to be charged to the government. And the documentation could include invoices, receipts, contracts, payroll records, or timesheets. And now that we understand the main concepts of what costs are allowed, and then we need to see how we need to set up the accounting system or how to determine the accounting system is adequate to properly track those costs.